Selling online is easy. Whether you're self-employed without a business account or a large corporation ready to join the global online marketplace, we have a solution for you. Accept payments via WhatsApp as well as other social media with NCB Payment Button. No website, no problem. Get started in minutes with ready-to-use customizable templates supported by NCB website templates, or sell to customers across the globe in an online mall with NCB Marketplace. Plus, get a pre-approved business credit card. At NCB, we have the right solution for your business to get you online and earning 24/7. Sign up today at jncb.com/e-commerce. Conditions apply.
Opening an investment account on GoIPO is easier than before. Using your NCB online credentials, simply log on to goipo.jncb.com to provide the required information. Our digital biometric identity verification system will confirm your ID instantly, so your account will be opened in minutes. Plus, now you can open your investment account with up to 3 joint account holders. So build your wealth and experience life with NCB Capital Markets.
Join with the NCB Foundation this year and help grant a wish and let it shine.
Visit grantawish.jncb.com to nominate the person you think could have the greatest impact.
They can receive up to $1 million towards giving their dream a chance to shine.
Visit grantawish.jncb.com today.
Nominate, vote, grant a wish and let it shine.
Grant a wish and let it shine.
You're always on the go. Take your bank with you with the NCB mobile app. Say hello to the banking app that does it all, right at your fingertips. Need to send money to family and friends, split the bill, or even pay your rent? Do it with a few taps in the NCB mobile app.
Good morning. I'm excited to be here today. Why? Because today, in fact, it has entitled The Great Reset. What you'll hear today is, on a go-forward basis, what NCB will be all about. And we'll hopefully define it in technicolor terms and with Dolby sound. You see, the problem with most companies is that there's misalignment between the owners and management. Here at NCB, that misalignment does exist, but our intent is to minimize it because, a smile here, the owner is in the house working with management. You see, the biggest problem that most companies have is what is called a principal-agent problem. You see, so what is that? If you own a calf, as the owner, you sing to the calf, you hug the calf, you ensure the calf is well nourished, you protect the calf, etc., etc., etc. Because you're the owner. That's what owners do. An agent, someone you hire, doesn't take the same attitude, generally speaking, as the owner. And if the attitude is not the same, you're going to get a different result. So that is the principal-agent differential. The challenge is to make every staff member behave like owners. Then the sky's the limit for both owners, staff member agents, and the organization. So, I'm going to use a very simple metaphor. NCB will be your dairy cow. The milk is your dividends. We're in the best position of any business to be a consistent dividend payer. Why? Because we're a combination of a major banking institution and a major insurance institution, unique in the world. Two entities that have survived centuries of existence. You see, paying dividends is most important because it signifies many things, which would include that the institution is well run and can deliver strong and reliable dividend income. Number two, institutions, financial institutions that pay dividends convey a message being related to capitalization, profitability, size, and institutional framework. The managers may know more about the true value of their firm than investors, particularly so in banking, which is a relatively complicated entity. You see, opaque balance sheets make banks and insurance companies difficult to analyze. So investors use the frequency and the amount of dividend payments as a proxy for financial strength. Additionally, by paying increasing dividends, managers signal to external constituents that they are confident about solvency. Regular dividends are a commitment and are pervasive for banks and insurance companies, and as bank and insurance companies, shareholders are not just receiving a dividend every quarter, they're receiving a message. Dividend announcement convey information about the future earnings, so more profitable financial institutions may be expected to pay higher dividends. At every point in this cyclical banking cycle, insurance cycle, dividend-paying institutions are likely to remain attractive, especially if the payout ratio is very sustainable. And lastly, well-run financial institutions feature amongst aristocratic dividend payers throughout the world for consistently paying progressive dividends as testimony to their conservative lending approach and capital strength. For the foregoing reasons, the payment of dividends from the NCBFG group is an imperative, not an option. The transition you have witnessed over the past 4 months is designed to enact that imperative. The focus over the past 4 months was to remove the friction and increase the horsepower to achieve the objective of making NCBFG the dividend payer of choice for investors all over the world. This meeting will be dedicated to tell you how we're going to do it and how you should measure us. Over the past 3 months since the last meeting, what have we accomplished? Well, we have declared and approved a dividend. First in 2.5 years. We reduced operational expenses by over $8 billion in annual recurring savings. We settled with our executive directors. We reset the focus of the organization to be dedicated to efficiency, governance, and the customer experience, EGC. And lastly, we have reset the relationship with our stakeholders, including depositors, customers, regulators, staff, government, the press, shareholders. We have recommitted to be guided by what we call the 3 Ds. And the 3 Ds are our behavior will be guided by, whenever we make a decision, the behavior has to be such that, or the decision has to be such that it does not impinge on the 3 Ds. The first one being, it doesn't distract us from our core business. It doesn't dilute shareholders. And thirdly, it doesn't impinge on the payment of dividends, the consistent and growing payments of dividends, the 3Ds. So we have recommitted to making sure that the 3Ds remain firmly implanted in what we do. Now, we're going to manage this business to be much more transparent to all stakeholders. And we're going to set the stage. We have set the stage for a spectacular 2024. So what can you expect for 2024, which started this past October the 1st? You can expect a renewed commitment to treat shareholders as partners. We are the operating partner. You shareholders are the financial partners. As partners, we report to you honestly, transparently, and always act in the best interest of the partnership. We'll manage your business or business with the following objectives. Number one, we'll manage our business to have the following outcomes: predictable and growing cash flow, a preference for consistent cash earnings, operational excellence, customer service excellence, capital efficiency, a culture of accountability and ownership, unrivaled governance, predictable and growing dividends, which are an imperative, not an option. And lastly, always conscious that we are building a better environment, a better region. Today, I look back at the past 4 months since July the 17th, proud of what we have accomplished in such a short time. Proud of the staff who have responded to heed our cry of be more. Proud of the directors, of our directors, for making tough, rational decisions, and I'm most excited to be looking forward to a spectacular 2024. And most importantly, happy for the shareholders who have been so patiently, who have so patiently shown confidence in their organization, never losing faith that better days are ahead. And better days are ahead. We never forget that NCBFG is the people's bank and the insurance company of choice, unique in the Caribbean, providing essential services to help our customers grow and create wealth over the long run while protecting and servicing their financial needs over the short term. Thank you.
Thank you, Chair. Ladies and gentlemen, Chairman, Honorable Michael Leachin, Interim CEO, Robert Almeida, Corporate Secretary Dave Garcia. Good morning. I'm Malcolm Sadler, CFO for NCB Financial Group Limited, and I will be presenting highlights on the group's financial results for the year ended September 30, 2023. Let me start by expressing my appreciation and gratitude to our team for the tremendous effort and resilience during the year as we continue to deliver commendable results. For the recently concluded financial year, we place a strong emphasis on laying the foundation for efficiency, which will continue into this year as we work to ensure costs are optimized and value increased within the organization. Our digital enablement within financial services has been another key area of focus. Our main objective has been to integrate technology that supports our overall strategy while enhancing customer experience and increasing operational efficiency. There's also been significant focus on capital and liquidity management, given expected regulatory and accounting changes. The most significant has been our preparation for the changes associated with International Financial Reporting Standard, IFRS 17, insurance contracts to be implemented by the group effective October 1, 2023, which is this quarter. Our Guardian Insurance subsidiaries have already adopted IFRS 17 effective January 1, 2023. However, the group's consolidated results for the year ended September 2023 were prepared based on IFRS 4, and IFRS 17 will replace IFRS 4. The implementation of IFRS 17 will materially change the financial statements in terms of presentation, recognition, and measurement of insurance contracts. We're proactively managing the implementation and expect a seamless transition at the group level. The impending implementation of Basel III for National Commercial Bank Jamaica Limited was also another area receiving significant attention during the year. The implementation of Basel III will result in higher risk-weighted assets, higher capital standards, and additional capital buffers, which will require greater capital efficiency and appropriate pricing of credit to maximize returns for our shareholders. Note that our regulatory entities continue to maintain strong capital and liquidity positions, given proactive capital and liquidity management practices to balance business expansion with shareholder value. Before I go into the highlights of the 2023 financial performance, I note that the prior year, 2022, results would have been restated only in our life and health insurance and pension fund management segment and in the holding company. The restatement was due to one-off actuarial adjustment of 4.3 billion previously booked in the December 2022 quarter in relation to the 2022 financial year. So it's booked in September 2023. Additionally, there was a restatement in the holding company in relation to certain staff benefits. The group reported consolidated net profit of 15.3 billion for the year ended September 2023, and that's a 19.8 billion or 56% reduction from the prior year. Net profit attributable to our shareholders was 7.6 billion for the year, representing a 68% or 16.3 billion reduction compared to the prior year. Operating revenues also fell to 137.3 billion, a reduction of 6% or 8 billion from the prior year. Lower net revenues from insurance activities resulted in an overall reduction in operating income. We will further examine the insurance segment later in the presentation. The net revenues from banking and investment activities increased by 5% or 5 billion due to improved gains on foreign currency and investment activities stemming from unrealized gains on equity investments, along with higher net interest income and net fee and commission income. While we have reported a 2.6 billion increase in credit impairment provisions, this reflects a normal level of expected credit losses given the size and risk profile of our loan and investment portfolios. The prior year included reversals of ECL provisions, which would have accounted for the significantly lower prior year expected credit losses. Operating expenses of 117.7 billion grew by 12 billion or 11%, mainly due to staff costs growing by 10.3 billion or 20% over the prior year. During the September quarter, there were changes in leadership and other areas, resulting in non-recurring expenses associated with the restructuring activities. Due to the restructuring activities and other factors, our cost-to-income ratio increased from 71.40% in the prior year to 82.54% in the current year. The group has identified and commenced implementation of various cost optimization strategies as we aim to lower the cost-to-income ratio. The lower profitability this year resulted in reductions in some of our key metrics as well. Return on assets, which fell to 0.71% from 1.76% in the prior year, and return on equity, which fell to 4.80% from 15.53% in the prior year. I'll briefly discuss the performance of our segments. Our life, health, pension fund management segment reported operating profit of 21.5 billion, which was 11.2 billion lower compared to last year. The segment's result was adversely impacted by increased net claims and reserves, notwithstanding the significant reduction in the operating results. This segment was the highest contributor to the group's operating profits. General Insurance recorded operating profit of 11.6 billion, almost doubling the prior year's performance. This was driven by increased net insurance revenues due to the maintenance of policies coupled with new business, principally from operations in the Dutch Caribbean and Bermuda, and increased other income together with reduced operating expenses. The Treasury segment remains the highest contributor within the banking and investment subsegment and reflected an operating profit of 9.9 billion, a 2.5 billion or 20% reduction compared to the prior year. The reduction was mainly attributable to lower interest income owing to rising market rates, resulting in margin compression due to reprice funding outpacing increases in interest income. The wealth segment generated operating profit of 8.8 billion, a 4% or 344 million decline compared to the prior year. There was a positive uptick in gains from investment activities with an increase of 721 million compared to the previous year. However, this segment also experienced a decline in net interest income due to rising interest rates, which impacted cost of funds. The current market conditions reduced market activity, which reflected in lower fees, commissions from investment banking and corporate finance activities. Nevertheless, we are actively aligning our portfolio to take advantage of the new opportunities. Corporate and commercial banking reported operating profits of 6.2 billion, 443 million, or 7% lower than the prior year. The segment's operating revenues remained comparatively flat. Net interest income increased, however, this was offset by higher credit impairment losses. The segment also incurred increased operating expenses. The payment services segment, which includes our card acquiring, card issuing businesses, as well as the operations for our mobile wallet Link, generated operating profits of 1.5 billion, declining by 755 million relative to the prior year. While we continue to see steady growth in our card services business, given increased card receivables, sales, and transaction volumes, the segment's net results have been reduced by the costs associated with the development of our mobile wallet Link. During the quarter, National Commercial Bank Jamaica Limited entered into an arrangement with TFOB 2021 Limited to take over the management of the Link mobile wallet effective October 1, 2023, which is this quarter. This is to capitalize on synergies with NCBJ's ecosystem strategy, anchored on broadening its customer base while deepening interactions between individuals and businesses. The ultimate goal is to create a centralized ecosystem platform, making it easier for all customers to access banking, insurance solutions, financial products, and payment options. This expands access and lowers the cost to serve for key demographics using a digital-centric model with superior user experience for acquisition, onboarding, servicing, and operations. Link is also set to enhance its remittance services by partnering with key service providers. We're focused on growing the Link product going forward. The consumer and SME banking segment recorded an operating loss of 719 million. The prior year included gains from execution of the branch optimization strategy in Jamaica, which resulted in the sale of real estate. Expected credit losses this year also increased by 1.6 billion. Work continues to transform the retail business to gain efficiencies and to improve its performance. We will now briefly discuss the components of the statement of financial position. Our asset base stands at 2.23 trillion, an increase of 147.1 billion or 7% over the prior year. The group continues to experience growth in our main earning portfolios, driven primarily by increases in net loans and investment securities, which grew by 6% and 15% respectively. Customer deposits grew to $747.9 billion, up 5% or $32.6 billion over the prior year. Obligations under repurchase agreements grew to $279.8 billion, reflecting a $32.1 billion or 13% growth relative to the prior year. Policyholders' liabilities increased to $459.5 billion, up from $441.5 billion in the prior year. Stockholders' equity increased to $170 billion, growing by 17% or $24.3 billion over the prior year. This was primarily due to increased retained earnings reserves and reduced unrealized fair value losses. Ladies and gentlemen, notwithstanding the reduced profits this year, the group continues to show strength and stability as our fundamentals remain robust and our outlook is increasingly positive. Our team is committed to delivering value to our stakeholders in every aspect of our business, as we have established a strong foundation for future growth. By now, you would have also heard of our EGC framework, which covers efficiency, governance, and customer experience, which are key pillars that will drive our performance going forward. In closing, I express my deep gratitude and appreciation to our exceptional team, whose efforts and resilience continue to be the driving force behind the success of the organization, and for our valued customers for your continued support and loyalty. We look forward to serving you for years to come. With that, I will turn over the proceedings to our interim group CEO, Robert Almeida.
Thank you, Malcolm. All right, let's get started here. It's always hard to, I'm just finding my notes here, there we go. So thanks, Malcolm, for doing a great job of walking our investors through the financial performance of the group. That is a really difficult task under normal conditions. It's especially difficult this year because the fourth quarter we were effectively doing a full renovation on a 747 jet while it was still flying. And if I can have you keep that metaphor in your mind for a moment, that's effectively what the fourth quarter was. So it probably looks like a very messy quarter. The financial performance reflects that complexity, and it could be leaving all of you confused about our current condition and the outlook. My intention, after the chairman's comments and Malcolm walking you through the financials, is to try and help you get a slightly clearer picture of our current condition and that outlook. In order to do that, let me just start by reminding you of the context. So first, to think about the context, I'm going to focus on one number that Malcolm referred to, the number of assets in our group. It's $2.2 trillion of assets. Now, that's a number, and I'm always very sensitive to the fact that numbers sometimes don't actually paint a picture. So when you think of that $2.2 trillion, I ask you to think about it's such a big number, and maybe a way to think about it is no matter what you do, no matter what you transact, no matter when anything ever happens in this region, there's probably a little bit of piece of NCB inside of it. And that means when you see a building, it could have been financed by NCB, it could be insured by Guardian, the people working in there, the rent may be collected on NCB payments, using NCB payments, either by the payer or the recipient. When a transaction is taking place, it could be taking place either with an NCB card or through an NCB point-of-sale machine device. When a business is growing, a hotel is coming up, it could be insured by Guardian. The employees in there could very well likelihood to have health insurance from Guardian. So when you see just about anything that's taking place in Bermuda or Jamaica or Trinidad or in the rest of the Caribbean, there's a really good chance that there's a piece of NCB inside. And that's the reach, the breadth of the platform, and what that number 2.2 trillion means in very real terms of how we all experience it day to day in the field. So with that picture of the platform, in July of this year, we, as a board, reached a conclusion that was captured in one line said by our chairman, the "I'm not happy" line. So we were not happy. NCB was not behaving or performing to the expectations, the standards that we all have for NCB, what we internally expect of ourselves, and what our customers expect of us, what shareholders expect of us, what the community expects of us. Operations were inefficient, capital was inefficient, customers were complaining, and we were not paying our shareholders for the use of their capital. Einstein said, the definition of insanity is continuing to do the same things and expecting a different result. In other words, if we weren't happy, then change was required. That change was articulated in the acronym EGC: efficiency, governance, and customer experience. And whilst the G, governance, is the middle letter, it actually comes first. All change starts with, first and foremost, taking responsibility for one's own behaviors. And that was the first thing we had to do. And then the next question is, what should guide those behaviors? And so in the EGC, what lies below that is, the starting point is the golden rule. Do to others as you would have them do unto you. And not doing to others as you would have them not do unto you. Customer experience, do what we said we were going to do, had to become an imperative. And thirdly, do what is efficiency, do what is necessary, and only what is necessary to serve the customer. If it's not necessary to serve the customer, it's waste. Do it right the first time, and in other words, a general focus on reducing waste. So with that reset focused on EGC, we embarked on a 3-month renovation that is reflected in the financial performance in the fourth quarter. Remember that during a renovation, we not only have everything from the past still there, but we also have all of the expenses associated with the renovation on top of that. And we would not be experiencing any of the benefits of the renovation. So I'm pleased to tell you that the core of the renovation is now done, and we are now improving on that reset platform. We meaningfully reduced expenses. We delayered the organization to get closer to the customer. There is a renewed focus on customer experience throughout the organization. Operational excellence is prioritized. One tangible example of this is the substantial improvement in ABM availability. We see it through the statistics that we monitor daily, multiple times a day, making sure that our ABMs are operating and available across this country. Those 300 machines that form a substantial component, almost 300 machines that form a substantial component of the entire network, about 800 machines across the country. And we monitor that continuously 24/7 to make sure they are available. We see through those statistics that there has been a dramatic improvement in the availability of the ABMs. The polymer note acceptance, we are 100% compliant with the polymer notes that have been introduced in the country and are replacing the old notes. So that is one area where we see substantial improvement, and we hear it kind of from our customers. Customers tell you when you do something wrong. They may not necessarily tell you when you do something right, but we do hear it from so we're not hearing nearly as many complaints about the ABM availability. We have improved capital efficiency, and we are well advanced in freeing up additional capital currently invested in non-core assets. Our shareholders authorized us to issue additional shares via an APO. We completed the settlement with the former executive directors, anecdotal response from our stakeholders, customers, employees, regulators, media, is all positive. And all of these activities put us in a position where we could declare a quarterly dividend. So that's why I say I'm pretty pleased with what's been accomplished in a relatively short period of time of a quarter. But all of that just gets us to a point and is history. Let's turn to what's a bit more important, which is our financial blueprint for the future. I want to give you the key performance indicators that are guiding us and that you can measure us against. In words, we are seeking to build a sustainable and growing enterprise that optimally serves its stakeholders. To do this, we have to reverse engineer. And I emphasize the words reverse engineer. So start with the end in mind, and then reverse engineer what it takes to ensure adequacy of capital, continuity of dividends, and reasonable growth in all scenarios that we can contemplate. We're a risk management organization, whether it be banking, insurance, capital markets. We are a risk management organization. And as a risk management organization, we do a whole lot of stress testing to ensure that that we, under a variety of different scenarios, the lights go on, computers work, customer cards can work, payments work, insurance is still there, everything continues to operate. Included in that is we want to ensure that we do ensure that we have continued adequacy of capital, and we're adding into that the continuity of dividends and then reasonable growth in all of those scenarios. In metrics, so try and make this a little bit more tangible for you. In metrics, this will look like the following. Group capital ratios, you'll see right now if you look at our financial statements, our equity runs around 10% of total assets. So group capital, so about 10%. We will be increasing from there. A return on equity, we're looking to have a return on equity in the mid to high teens. And I'm going to say we're looking to have that, but it's actually an imperative because that's what's required for a sustainable business model. A return on equity in the mid to high teens. A dividend payout ratio in the vicinity of around 50%. So pay out about half in dividends, keep about half to reinvest to fund growth of the business. What that would do is it means a reasonable growth target for us is in the area of around 10% per annum. All of this should translate into a higher share price with an attractive dividend yield. We also are looking to have a cost-to-income ratio around 60% or lower. Please note that a financial institution with these metrics is not only an attractive investment, but it would have lots of shock absorbers that are critical for this institution to deal with any extreme shock that comes our way. In other words, we would be extremely resilient. Now, I threw out a lot of percentages there, and I'm the first to acknowledge that percentages are difficult to understand. They're not tangible. They're not something you can necessarily touch or feel. So let me translate at least a couple of those KPIs into something that's a bit more easily relatable. We have consolidated equity of about $224 billion and about $170 billion of shareholders' equity, equity net of minority interests. When you apply a 15% return on equity on those figures, that translates to a consolidated net profit after tax of just under $35 billion. And $25 billion when you net out minority interests. That is where what we consider to be a stable base, not our aspirational targets. That's a stable base to be, that is the base of a sustainable business that is highly resilient. And from there, we can continue to grow. Now, you may be thinking that's a long way from where we are, because if you looked at some of those numbers, you would have seen some really low ROE numbers and some really high cost-income ratio numbers, and you would have seen a net profit for the full year attributable to shareholders around $7.5 to $8 billion. But remember, I'm asking you to remember that we were doing a full renovation of the 747 jet whilst it was still flying in 2023. 2023 has all of the expenses of the renovation and none of the benefits. We are reporting that a net profit after tax, net of minority interest, of about $8 billion. But this NPAT includes a number of non-recurring expenses that Malcolm referred to. Items such as separation expenses, redundancy costs, and a number of other one-time provisions, as well as reduction. In addition to all of those one-time items, there are reductions in annual recurring expenses that were there in 2023 and will not be there in 2024. On an after-tax basis, if you adjust for those items, the 2023 net profit after tax of around $8 billion, that's attributable to shareholders, so net of minority interest, would increase when you adjust it for those one-time items and the expenses that are no longer recurring going forward. That jump-off point for 2024 gets closer to about $20 billion. So entering 2024 at that level puts us within striking distance of that $25 billion number that I just referred to. And with the number of strategies that we have in process that are well advanced, in an advanced stage of execution, I'm optimistic that we get to our sustainable base targets by the end of 2024. In summary, in July, we were not happy. Over the next 3 months, we completed the pivot. We have a clear blueprint for a sustainable base business model with clear and measurable KPIs. We are entering 2024 not far from those targets, and we are now accelerating. To be clear, there is a lot more to do, and we have to, and we will, stay disciplined. I've provided you with a set of metrics that you can use to challenge us on our performance and progress, and in the course of that, help us maintain our discipline. Achievement of these metrics means sustainability, it means resilience, it means recurring dividends and reasonable growth. More importantly, achievement of these metrics means happy customers, happy employees, happy regulators, happy community, happy shareholders. Thank you. I'll pass it over to Dave.
Okay, thank you, Rob. So as usual, I will take the questions that we have received before the meeting and some of them, and then take questions that we have received during the briefing. And we will take as many as is feasible, and then any that can't be taken in the meeting, we'll ensure that those get a response by email afterwards from our investor relations team. So Chairman, we have a few questions here for you. Mr. Stephen Flowers has said, you have always been an acolyte of Mr. Warren Buffett, the master capital allocator. How do you feel about the possibility of issuing shares that are undervalued? Is the impending dilution worth it?
No one can feel good about issuing shares that causes dilution. As I said, the imperative on a go-forward basis is to run this operation and make decisions based on the 3 Ds. We will behave in such a way that we minimize distractions. We'll behave in such a way that we do nothing to impinge on our dividends. And lastly, we'll behave in such a way that we minimize dilution. So with respect to the APO, you can be assured that what we have done, we have built enough resiliency over the last 3 months that the APO we will be doing an APO, but it's not that we have to do an APO to pay the dividend, or we had to do an APO to settle with our former executive directors. The company is strong, resilient, and has enough capital reserves that it was able to do all of those items, and the APO will get done, but it's now not that we had to do the APO. We have to do the APO to get the 747, righted, as Director Almeida mentioned.
All right, thanks, Chairman. And I think in the context of the capital, numbers that Rob would have mentioned earlier, I think we understand, shareholders would understand why there is still the need to have some focus on that buildup of capital. A second question for you, Chairman. I like this question. You have correctly described NCBFG as an absolute fortress. That's my favorite part of the question. So, a player on its own stage. Do you still see the group as world-class, having global ambitions?
On July the 14th, when that famous article was written, I'm not happy. I certainly didn't see it as world-class, because world-class organizations, they don't have an efficiency ratio of mid-70s. World-class organizations do not have, the world-class organizations are very disciplined. And thirdly, world-class organizations, they don't have the complaints that we were having from our customers. That's then. We have, over the last just 4 months, we have righted all of those 3 areas. Not perfect yet. There's lots of work to be done. We have righted in terms of have the staff align to being a lot more efficient. And as I said earlier in my comments, being efficient starts with taking ownership. Treating this business as a staff member, that this business, I have an income-generating asset. My salary. This business is providing me with my salary. It is my income-generating assets. I have to take ownership of it, or else my income-generating asset is impaired, will be impaired. So it is getting to each staff member, to inoculating each staff member to think that this business is their income-generating asset that they have to take absolute ownership of. And that is where we're going to get to the efficiencies that we want, because owners are efficient. It will also, once each and every staff member start thinking, I am an owner, firstly, of my income-generating asset, which is generating my salary for my family. That will also redound to better discipline and implicitly a bit more governance throughout the organization, starting at the grassroots. And thirdly, once you take ownership, you are mindful that your customers pay the light bill. So you have to make sure you take care of the customers and envelope them in love, in services, so that they can go and tell their friends how good a job is being done at NCB. So I wasn't happy on the 14th. We're now well on our way to leaving that behind us. It's clearly defined as to what it is we have to do, and we are well on our way to get it done. And as you all know, if we say we're going to do something, we do it. In August, we said we're going to have a dividend paid, having had a hiatus for 2.5 years, and we're going to have a dividend paid before the end of the year, before Christmas. So said, so done. That's the NCB you can rely on. Because at the end of the day, we are the people's bank, we're the people's insurance company.
Thank you, Chairman. And a third question here from Mr. Flowers. For you, you can decide if you will take it or if you will kick it to Mr. Almeida, who has, I think, to an extent addressed some of it in the, well, has alluded to part of it in his comments. Mr. Leachin, you have stated that dividends are now an imperative, and you have proven that you are a man of your word in meeting a dividend before Christmas as promised. Is the company's dividend policy still in effect as stated in its annual report, where it states the company reserves the right to increase future distributions proportionately for years when payout is less than 50%? Well, I can answer that part of the question. It is still in the policy. It hasn't changed recently. So that being the case, The question then is, when can shareholders expect this reward after this arduous hiatus?
So, as you all know, Director Almeida and myself, we have been joined at the hip for a very long time. And what I have a habit, whenever the questions are hard, I say, Rob, help me. You take this one, Rob. So, Rob, take this one.
So I'm trying to think of the question. If the question was about does the dividend continue, I think I tried to, in my remarks, tried to state that the way we're reverse engineering the business, so in declaring the dividend, it's on the expectation that we are in a position to make it a recurring dividend. If the question was about increases in dividends, then I think, yeah, the goal is to just focus on those metrics, which is if we're achieving a 15% ROE and we're able to, and we're already well capitalized. A lot of investment has gone into making sure we're well capitalized, and we'll be increasing our capitalization over the next few years. Partly to just keep strengthening the fortress, partly to as Basel III gets implemented. But as we do that, we're very conscious of being able to make sure that we meet we continue to pay out on dividends, and secondly, that we're actually able to keep increasing the dividends in a pace that keeps the whole system in balance. And so that would be definitely that's our goal, that's our commitment of what we have conviction around doing, and we will do, and we're just determined to get that done.
Okay, thank you, Rob. A couple other questions for you. So these two are I'll ask them together in respect of EGC. One is whether there are any specific metrics for EGC, and then also does EGC apply to Guardian and Clarion or just NCB, the bank, NCB Bank, and its subsidiaries?
So I'll start with the back part of that question. So EGC applies across the board and has been adopted across the board. It's been adopted more formally inside of NCB, the bank. So where you'll actually see cards, you'll see material that people. So it's been embedded formally inside of NCB, the bank, but the principle of EGC is being executed across the entire group. Guardian actually is making tremendous strides in EGC, notwithstanding, like I said, not having necessarily formally put it into employee materials and collateral materials and things like that. So the metrics, at the level we're talking here, the metrics look like a cost-income ratio. So they distill down to a cost-income ratio. They distill down to us having profitability and return and a mid to high teen return on equity. There are many more metrics inside the organization. As I mentioned when I talked about ABMs, we get very granular. We measure ABMs, we measure ABM availability, but we don't just measure ABM availability. We measure it at the exact fault level. We measure so we know whether it's a receipt printer fault or whether it's a cash jam or what it is, and we measure prime time, we measure non-peak hours, we measure branches and non-branches. So we have a lot of granular measurement. We measure our net promoter score across the board in all of the organizations to monitor the customer view. But metrics are one thing. We also want to be listening exactly to our customers. Call center volumes. People are calling us. When people call us, it's usually because they have an issue. And so we're monitoring our call centers because they're a repository of what works and what is not working, what needs to be fixed. So long answer, but the shorter answer would be is there are metrics, the metrics that you will see, and we're asking you to pay close attention and challenge us on, is follow that cost-to-income ratio, follow that return on equity, follow us on our dividend payout. They're all indications of how good we're doing with EGC. And at the execution level, we're much, much more granular and monitoring it and studying it. And that is one of the big changes that we will look to see happen more over time is to actually embed that process engineering and reverse engineering approach into the organization, where we are continuously being data driven to remove defects, find things that are not working, and eliminate waste.
Okay. Thanks, Rob. Another question from you, and these questions, the ones I just asked and the next one, are from Bambi Pusola. The question now is, can you give some guidance on 2024 earnings? And I think you had some comments in your remarks earlier, so I'm not sure if perhaps some more is sought here.
Well, I think I'll just actually clarify and repeat, because as I spoke, again, it's a lot of numbers, and it doesn't necessarily, you can't put it in the context of the specific question. I was trying to answer that question in my remarks by coming at it two different ways. One is, what do we believe a sustainable base business model to be? What's the blueprint we're engineering? And that blueprint is, as I said, a mid to high teen return on equity business. And if you take a 15% number and you multiply it by our $170 billion of equity, you get to a number that looks like around $20-odd billion, actually closer to $25 billion attributable to shareholders. So that's kind of one way of looking at it. The other way of looking, so it's around 25 billion would be that base sustainable business model, and that's what we're engineering towards. The other side I was trying to get you to is, where's our jump-off point coming out of 2023 going into 2024? And when you look at that, you'd start off with the $7.5 to $8 billion of net profit after tax that's attributable to shareholders that we reported in our release. But you take that number and you add to that number the fact that there were quote-unquote renovation costs, so all the non-recurring one-time items that took place in 2023. And then you also add in all the benefits that come out of those renovations, which are the cost reductions of expenses that continued to be incurred in 2023 and will not exist going forward. If you look at our financial statements, you'll see some numbers of about $8 billion on separation costs. We've talked about $8 billion of cost reductions that we've taken out of the business on a recurring basis. You add those two numbers together, you get $16 billion. You tax affect them, it'll come down a bit. But when you add those numbers together, $8 billion of a jump-off point, 2023 going to 2024, add in $8 billion of renovation costs and add in $8 billion of benefits from the renovations, and you'll get to a number that looks like we're entering 2024 at about a $20 billion run rate. And so that's how I would answer the question in terms of how I'm looking at the 2024 year.
Okay. Thanks, Rob. And then for Ian Chinapu, I have a question here. So Ian, can I just check that you're hearing fine and able to speak?
I am hearing. Can you hear me?
Excellent. Hearing you fine, Ian.
Great.
So the question from the same sender is, what is the reason for the decline in Guardian's profit from 2022 to 2023? And I'm going to ask you, when you speak to that, perhaps you can also comment on, generally on your perspective on the recent performance of Guardian and the outlook for 2024.
Oh, thank you, and good morning, everyone. So, as Malcolm Sadler would have shared earlier, we are presenting these numbers under IFRS 4. And without boring you too much on the IFRS 4 versus IFRS 17 technicalities, under IFRS 4, movements and reserves are basically calculated by present valuing future changes in certain variables like inflation rates, interest rates, expenses, etc. What we had in 2022 was about 7.5 billion Jamaican dollars in positive movements in reserves that were one-off, essentially due to changes in operating structures. What we had in 2023, again under IFRS 4, was about $17 billion Jamaican equivalent in charges due to higher reserves and an increase in net claims. That reserve portion would not actually occur under IFRS 17. So in due course, when you look at our IFRS 17 numbers, you'll actually see an improving performance 22 over 23, because what happened in the rising interest rate environment, Guardian actually had significant policyholders who would have invested in, or who would have had policies with an investment feature, so that as interest rates started to rise, we would have provided for those via reserves, which would be an expense to us. But in due course, over time, those higher interest rates would actually benefit the company as well in our own proprietary investing book. But under IFRS 4, we had to present value that expense and take it all at once. The second part, as I mentioned to that, is higher claims year over year, particularly in our health and our property and casualty area. We also had an increase of about 4.3 billion Jamaican dollars in our reinsurance expenses, as I think we all know reinsurance costs have been rising. So those are things that actually would continue, higher claims and reinsurance expenses that we would be managing and monitoring. In terms of the higher claims, we saw over the last 18 months an increase in elective surgeries, etc., coming out of the COVID period where those things were deferred or delayed. So we see that spike in claims, particularly health claims, as a result of that normalization of prior years where those things were not done. As time goes on, we would see a return to the pre-COVID levels of surgeries, elective surgeries, etc. So while we expect that there will be some inflationary impact, we do not expect the spike that we saw in early 2023 in terms of health claims continuing indefinitely. Now, we've also done, and I love the question, I know Mr. Almeida answered it, but we are very deeply ingrained in EGC. So year over year, our actual operating costs are down already 5%. And we have measures and actions that we are taking to actually go for achieving as much as 15% as we go forward into the new year. So looking forward, Dave, to the question that you asked about outlook for this year, as we also present numbers under IFRS 17, and we normalize and remove, under IFRS 17, by the way, you don't present value the effects of those variables like inflation, interest rates, etc. You actually match it to the period in which it occurs. So you don't have those material movements in reserves that would actually cause significant volatility up and down in your earnings. What we are seeing is a more consistent picture. So we actually are up in our gross written premiums by almost 8 billion Jamaican dollars is what we are seeing, which is 345 million TT. So notwithstanding the higher reinsurance costs, etc., and the higher inflation situation, we've actually reduced our cost 5%, and we continue to grow our gross written premiums. That bodes well for us into 2024 and beyond. So as we adopt and embrace EGC and manage our expenses and refine our operations to be most efficient, we're also continuing to invest in technology that enhances our customer experience. We are significantly invested there, and we are implementing a new life, health, and pensions insurance platform, which would greatly improve our customers, our ability to respond to customers, our turnaround times on claims, and all of the things that our reporting metrics for regulators and auditors and shareholders will all be improved as we make this investment. So it's not unlike what our interim CEO said in terms of the plane is in the air, but we are still enhancing the engines and improving on all of the things that make the flight an enjoyable one. So as we go forward into 2024, we expect to have continue to make a significant contribution to the NCB Financial Group and its performance, and also to its customer experience. And while in doing so, still becoming even more efficient and reducing our costs year over year. I hope that is a good answer. Thank you.
Yeah, I think it does answer it, and quite comprehensively. Thank you, Ian. And then I didn't actually get a question for you, Ian Truron of Clarion, but I would ask you to also comment generally on your perspective on the performance of Clarion for the 2023 financial year and the outlook for 2024 as well. Ian?
Thank you. Thank you very much, Dave, and good morning, ladies and gentlemen. I am pleased to report, as I have done throughout all of the quarterly briefings, that there has been continued execution and delivery of expectations at Clarion. Thematically, I'm going to focus on 4 areas, that of capital, asset quality, liquidity, and profitability. From a capital perspective, I'm pleased to report that our capital adequacy position, our CET1 capital ratio, has improved from approximately 22.5% to that of over 27% as at year end, September 30th, 2023. Why is that important? One, from perspective of resilience and that of governance in alignment with the chairman's messages of governance and efficiency and CX. It enables all of those factors to be built into the future. And that of then also growth, that we have a balance sheet that is supportive of future growth. Insofar as asset quality, along the lines of the trends reported previously, we continue to experience improvements in our asset quality, specifically on our non-performing loan ratio. That number improved by a further 13% year on year. And I'm pleased to report that that number now sits below 6% as an NPL ratio. I'm not entirely satisfied with that number. There are further improvements required, and we have a pathway to see that number improve throughout 24 into 25 and 26. Insofar as liquidity, again, positioned well for resilience as well as growth. In Bermuda, we are fully compliant with the Basel III requirements, that of requiring a 100% liquidity coverage ratio. And I'm pleased to report that Clarion has significant surplus liquidity sitting at north of 170% as at year end. How does that then all translate into profitability? We experienced a 98% improvement in our profitability. We're reporting a profitability of $11.2 million as at the year end. Again, extremely pleasing percentage-wise to be able to report further improvements required insofar as achieving that mid to high teen return on equity, as Mr. Almeida has reported, is the ambition of the group, and we would expect to align to that also. Some non-qualitative metrics insofar as how are our customers feeling about the organization, how are employees feeling about the organization. And I'm pleased to report that from an NPS perspective, we are significantly higher than that of our peers. But with that being said, I believe that the baseline is relatively low, and we have and are implementing ways and means to improve our customer experience further. And also on our employee engagement perspective, we've seen significant double-digit improvement in our employee engagement. We now sit at near 70% employee engagement. So from the customer and from the employee perspective, I think we bode well for the future. Incorporating and looking forward into 2024, we have completed our 24 to 26 strategic plan, 7 strategic priorities. That primarily focused on growth being the first, sustainable growth as indicated by both Mr. Almeida and the chairman. Operational excellence, improving the way in which we deliver our services such that we can deliver them more efficiently and in alignment with improving client experience. Generally, client experience is a strategic priority across the board, continuing our digital rollout and interface with our customers, that improving areas of complaint handling and turnaround times. And lastly, employee experience. Foundationally, the 3 other strategic priorities are risk management. Again, in alignment with Mr. Almeida, we are risk managers. That is what we do. And there is significant change afoot in Bermuda with regards to regulation and the risk management associated with that. I think that Clarion is well positioned to be able to keep pace with that and deliver accordingly. technology, like Mr. Chinapu, Clarion is all indicated at Guardian. We are also in the midst of a core conversion, and we'll be delivering that throughout 2024 and late 2024. That will enable both efficiency improvements in client experience and regulatory reporting requirements. And lastly is data and analytics, our ability to utilize the data not only to improve our existing capabilities, but from a predictive basis to be able to improve the client experience on going forward. So I am confident as I look forward to Clarion as well as the Bermuda environment. We have a stable outlook and a continued A+ external credit rating, and I expect that Clarion should continue to be able to penetrate the banking and wealth management sector here as well as into the region as well. So thank you very much for the question.
Okay. Thank you, Ian. And our next question I will direct to Malcolm Sadler. It comes from Stephen Jackson. Analysts are asking for information in the report on the separation figures for the 7 or 8 executives who have left. Clearly, there are constraints on what you can say, but Malcolm, I'll allow you to answer.
Okay, thanks. Thanks, Dave. Thanks for the question. So, as would have indicated, we have made provisions, or we have included those amounts in Q4 for all executives. Our audited accounts will be released shortly, and as usual, we will include additional information in terms of key management compensation. So that will be outlined in the note. But as at September 2023, we have full provisions for all separation costs.
Thanks, Malcolm. And a question now for you also from David Rose. NCBFG will be reporting under IFRS 17 going forward. Will there be a segregated breakout or guidance going forward on interpreting the new standards?
Yeah, thanks again for the question. So Ian would have given you a preview earlier in terms of his comments on IFRS 17 and the differences between the two standards. So NCBFG will implement IFRS 17 effective this quarter, and we will update the notes outlining the IFRS 17 framework and the impact on the financials. We'll also restate the prior year, so you'll be able to see the impact on the December 2022 quarter compared to December 2023 when we implement. And as we go through the year, you will see more and more the impact of IFRS 17. But yes, we will outline IFRS 17 in the basis of preparation in the notes to the financial statements for December 2023, so that shareholders will get a better understanding of what IFRS 17 is all about and the changes compared to IFRS 4. Generally, what we have seen so far is a reduction at the start, a reduction in profits when we implement IFRS 17, and then we see improvements thereafter.
Thanks, Malcolm. We have another question from Mr. Rose, also on separation costs. I suppose a little bit similar to one answered earlier, but I'll ask it nonetheless. With respect to the fourth quarter of 2023 and separation costs, were these costs related largely to all the named executives or just Messrs. Hilton and Cohen?
So it would be for all executives. The more significant portion of it would be for the executive directors.
Thank you. And Rob, question for you. What is the plan to further integrate the different NCBFG subsidiaries?
Okay, that's a great question. So I'll come back to it in a moment. Okay, I just wanted to pick up on one thing on the questions on the separation costs. I will, when the full financial statements are released, with all the notes, there's pretty good disclosure in there, and so I wouldn't want you to. I want you to say we do want to be very transparent, and make sure that you have the requisite information that's relevant for assessment, as well as assessing how we're performing and your view of our future. In a few weeks, when the actual financial statements get released, the full set of audited financial statements gets released, there will be note disclosure in there that'll take you a long ways to be able to answer the questions that you just asked on separation costs. With respect to the integration of the subsidiaries, that actually, so while we're doing this reset, that is actually the big opportunity that sits in front of us going forward. Is to date, we continue not to have actually extracted or realized on the synergies within the broader group across the subsidiaries, and we're starting to. So first, we had to just make sure there's no point integrating bases that aren't efficient, aren't necessarily don't have great customer experience. So the first thing is just make sure that each individual business is operating exceptionally well. But yeah, we've got this really big opportunity in front of us, which is to realize on the synergies of the broader group. Ian Truran, Ian Chinapoo, Bruce Bowen are all, the whole team is fully on side with that as an objective. There are certain things that are starting, and some of them are actually just within the NCBJ group, for example. We've had an announcement about a new person joining up or setting up a wealth management as a segment or a division, and using that as a way to actually start to realize on the synergies that exist within the group, and in fact not just within NCBJ, but actually within NCBJ, NCB Capital Markets, so NCB the bank, NCB Capital Markets, NCB Insurance Agency, Guardian, and actually try and make sure that from a wealth management perspective, we bring the full power of the platform to the benefit of the customer, and also for the benefit of our that'll redound to the benefit of our organization and shareholders. So it's a great question, because it's actually kind of like the next chapter after when I laid out, here's what we need to get to as a sustainable base business model, the blueprint. The next chapter after that is actually realizing on the power of this group platform, and the team is ready for that, starting to move in that direction, but that probably won't accelerate until after 2024. So that'll be more of a next stage later towards the end of 2024 and into 2025 and 2026. But it is the big latent opportunity inside the group.
All right, thank you very much, Rob. And I think the last question that we have to take this morning comes from Bambi Posola, and it is, are there any plans, and this will also be for you, Rob, are there any plans for North American acquisitions?
I'm just going to go back to framework, the 3D framework. So North American acquisitions, short answer would probably, two short answers. One is never say never on anything. That would be, we always keep our eyes open. But apply the 3D framework to it. Chairman will actually use the words of saying you can expand to Mars if you'd like, as long as it doesn't violate the 3Ds. And I'd use that as the metaphor that says, if you think about the 3Ds, if you think about distraction, if you think about dilutive impact, that dilution that would be required of capital, if you think of dividend and impact on what it might mean for dividend continuity, you'd probably see that it's a pretty remote possibility that we would be looking at a North American acquisition.
Yeah. All right. Thanks, Rob. And with that, we will, and I thank everyone for not just for the questions, but also our panelists for the comprehensive and insightful responses, I think, to the questions that have been asked. And with that, I'll hand over, Chairman, for you to close out the briefing for us.
Thank you very much, Dave. Thank you very much, Rob. Thank you very much, Malcolm. Just in summary, as I started by saying, this really is, over the last 3 months, was a great reset. Resetting the business to be very transparent, so you know exactly what we stand for. In a colloquial term, we are, as of now, a dividend-paying cow. So, in terms, using Mr. Director Almeida's language, that's the goal, and we'll now we are in the process of re-engineering, reverse engineering, everything from that to make sure that that objective is met, because it is an imperative from the board. It's not optional. That dividends, increasing dividends, will be continuous and also growing, continuous, growing, and recurring. Well, that's continuous. I'm really proud of how the staff has responded to this reset. It's not easy to be resilient, but our staff has shown that resilience. I'm really proud of our directors, that they were able to make some very tough decisions, and the decisions were very tough over the last 3-4 months. But we did it, and in doing it, it demonstrated the confidence that Jamaica has in the institution, and for that we are humbled and proud. And one thing is for sure, we will not let you down. This is the People's Bank, and we are mere stewards, and we're going to make sure that you're all proud of us and proud of your investment. Thank you.
You're always on the go. Take your bank with you with the NCB mobile app. Say hello to the banking app that does it all, right at your fingertips. Need to send money to family and friends, split the bill, or even pay your rent? Do it with a few taps in the NCB mobile app. It's as easy as 1, 2, 3. Say goodbye to long lines and yes to hassle-free. Pay your internet, electricity, water, and all other bills with just a few taps, so you can use your time to do what you love. Stay connected to those that matter most. Tap to top up and send phone credit to your favorite person, anywhere, anytime, any network. Download the NCB mobile app from the Google Play or App Store today and enjoy convenience at your fingertips.
In 2019, we gave you Go IPO, the region's first digital IPO application platform, revolutionizing the local equities market. With over $7 billion in capital raised via this platform, the innovation continues. Now we introduce the Go IPO Bond Portal, giving you a fully digital bond offer experience from application to confirmation. So there is no need to go in branch and no extra fees, because seamless access to wealth starts with the NCB Capital Markets Limited. Visit goipo.jncb.com. Click offers, then bonds.
Most fraud cases stem from one simple action: clicking on a link or sharing personal information online through text or over the phone. Remember, NCB will never send links through text, WhatsApp, or emails, and NCB will never contact you to ask for your PIN, password, RSA token, or credit card number. Don't be quick to click or share your information. Don't fall for fraud. For more info, visit jncb.com/protect yourself.
Today's woman is not just an entrepreneur, a mother, or the girlfriend that gets all the girls together. She's all that and much more. We call her a queen. She's driven to live life to the max, and nothing should slow her drive down. That's why Guardian General's Queen Guard Motor Insurance was created with this woman in mind. delivering benefits like 24-hour roadside assistance, uninsured motorist protection, windscreen coverage, replacement of personal belongings, speedy claims settlement, and so much more at affordable premiums that won't break your pocket. For more information, contact your broker or call us at 876-935-6681 or toll free 888-468-3474.
No matter who you are, where you are, or what you do, Link are for everybody. Whether you find yourself in a little situation on the hustle, or you're not in the hustle for leave home, we're here to help. Keeping you topped up, putting the solution in your hands, and giving you the joy of choice and convenience, especially when it comes to getting back what's owed. That's why life is better with Link.
Many years ago, NCB began serving Jamaicans at the corner of King and Harbor Street in downtown Kingston. I often ponder about that moment, the aspirations and dreams those customers must have had walking through our doors. As the world around us has evolved, so has NCB. Yet, the heart of what we do has not changed. I acknowledge with sincerity the challenges we have faced, but every challenge brings lessons, opportunities for growth, driven by EGC, which means efficiency, governance, and a renewed focus on customer experience. We're not just adapting, we're transforming. My promise that every interaction with NCB will be simpler and more memorable, delighting you at every turn. As we journey forward, I cherish the stories and dreams you share, knowing that they are the foundation of our shared legacy.
The way you've built your career into a masterpiece, so you can have days that look like a work of art, will be the legacy that will live on as your crowning glory. Now let us help put the finishing touches on your brilliance with Clarion's vast experience, deep expertise, and digital tools, all focused to give you what you deserve, the finest things in life.
The first sound they make is to simply let the world know they're here. And then it's our duty to help them show the world why they're here in the first place.
Give them every advantage with the Guardian Achiever, a plan that provides for their educational dreams and protects their health and life in the process. For more information, call 888-4LIFE to speak to an advisor or visit myguardiangroup.com.